Welcome to The Explainer. Today, we're cracking open the books of a European investment giant, Investor AB, to see exactly how it navigated a pretty tricky third quarter in 2025.
So how does a company with that kind of scale handle a shaky global economy? Well, let's find out. We're going to dive right into their latest report.
Here's the game plan. We'll start with the headline results, then we'll break down how their public and private companies performed, check in on their EQT investments, and finally, see how their financial strength sets them up for what's next.
All right, first up, the report card. So, how did they actually do this quarter? Let's get right to it.
The company's own CEO, Christian Cederholm, kicked things off by basically saying, hey, it's tough out there. He pointed to rising trade friction and geopolitical tension as some pretty big worries.
And yet, even with all that going on, they didn't just tread water. They actually thrived. Investor delivered a total shareholder return of 5%, which handily beat the broader Swedish market's 3%.
And this really puts their size into perspective. Their total worth, what's called net asset value, grew by a whopping 67 billion kroner in just 3 months. That pushed them over the 1 trillion krona threshold. That is a massive number.
Okay, so how did they pull that off? Let's start by looking at the biggest piece of their pie, the companies they own that are traded on the stock market.
So what's really interesting when you look at their portfolio is the mix. You've got these huge industrial players like ABB and Atlas Copco, but then you've also got big stakes in defense with Saab and banking with SEB. That diversification, it's absolutely key.
And here is where you see that strategy pay off big time. I mean, sure, a consumer-focused company like appliance maker Electrolux has really struggled, but the portfolio was absolutely supercharged by others. Remember that geopolitical tension the CEO mentioned? Well, just look at Saab. The defense contractor's stock is up an incredible 146% so far this year, which is a direct reflection of the current global climate.
Okay, let's switch gears to Patricia Industries. Now, this is a totally different ballgame. Here, Investor isn't just picking stocks. They're acting more like long-term owners, growing companies away from the day-to-day craziness of the stock market.
Before we jump into their numbers, there's one key term you gotta know: organic growth. It's a really important metric that cuts through all the noise from things like currency swings or acquisitions, and it shows you how a business is really doing underneath it all.
And this is why that matters so much. See, if you just glanced at the headline number, you'd think sales for these companies fell by 4%. But that's just an accounting thing, mostly because the US dollar got a bit weaker. The real story? The businesses themselves actually grew organically by a very healthy 4%.
But the biggest news from this division was a massive strategic move. One of their companies, Advanced Instruments, bought Nova Biomedical for $2.2 billion, with Investor kicking in $1.6 billion directly. And now they've combined them to create this single, much larger life science powerhouse.
So, Investor doesn't just own companies directly. They're also a founding partner and a major investor in the global private equity giant EQT.
This quarter, the value of their EQT investments saw a pretty modest 1% increase. But honestly, that's not the real story here. The interesting part is where they're choosing to put new money to work. Case in point, they pumped another 1.8 billion kroner into Fortnox. That's a Swedish cloud-based software company. This is them really doubling down on their long-term bet on the whole shift towards digital business. So, with all this activity, how is Investor positioned for whatever the world throws at them next? In a word, strong. And it really all comes down to financial flexibility.
Take a look at their leverage, which is just a fancy way of measuring their debt compared to their assets. It is sitting at just 2.6%. I mean, that is comfortably at the super low end of their own target range.
So what does that actually mean in the real world? It means they have a war chest with almost no debt and nearly 24 billion kroner in cash. They have some serious firepower to support their existing companies and to pounce on new investment opportunities as they pop up. Which brings us right back to where we started. In a world that the CEO himself describes as having significant geopolitical tension, this kind of financial strength is a massive advantage. So the big question now is, what are they going to build with it?